Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully all of you are having a very nice weekend so far. And in Friday's price action, guys, well, as a matter of fact, the bulls capping up a very beautiful week. However, the Friday session ending a little bit red, the bulls possibly getting a little bit tired after the last recent 6 or 7 days worth of rally in a row, consolidating for all intents and purposes, though, near the all-time highs on the SPY and very close to the all-time highs as well on the Qs. And this week, guys, is going to be a very crucial week in the market because we have a flurry of news events coming at us. Now, number one, of course, is going to be the Fed meeting coming in on the Wednesday session. And of course, we have a number of different big tech earnings coming over the course of the week. So the markets this week could move in a very big fashion. So in today's video, guys, we are going to take a look at a few key things together. Number one, we're going to be going over two earnings reports that happened last week. Number one is going to be Texas Instruments, an insight into the semiconductor industry. And number two is going to be American Express. They had their earnings Friday morning. So we'll get to take a look at the health of the consumer. American Express usually caters to a more high-end income consumer. So we'll take a look at how those guys are doing from their earnings report. Thereafter, guys, we're going to take a look at our major technical analysis rundown in terms of the SPY, the QQQ, and the minor sectors. Take a glimpse into our sector rotation and see whether or not it's healthy or are there some problems potentially on the horizon. Thereafter, take a look at our big tech names. Same thing. How are the big tech names shaping up into earnings? We'll take a quick look at the technical analysis and derive potential levels of interest to the upside or to the downside for them. And lastly, of course, do a portfolio review for the trades made this week and the ones that I'm keeping into next week as well. Quick little glimpse. This week was a very good week of trading for us in the Discord, guys. All the wheel trades pretty much ending up with wins, some directional trades as well, and overall profitability on some of our earnings swing trades as well. So we'll take a look at that at the end of the video. So without further ado, guys, a lot to talk about today. Let's jump right into the action, shall we? So the SPY down about 0.29, the Qs down about 0.57 on the Friday session. Overall, though, not that bad of a day. The bottom half of the market did do a good job in holding up the SPY, but a lot of the damage was done by big tech. Big tech having phenomenal rallies here over the course of the last 1, 2, 3 weeks individually, but overall Friday was a red day for them. When we take a look at the one-day relative performance, you will see that it was somewhat of a mixed market, led to the upside by communication services, utilities, and consumer defensives, but to the downside, a little bit of problems here in industrials, energy, and technology on the Friday session, of course. However, after 5, 6, 7 days of rallies worth of upside, we do have a nice 1 week relative performance where everything except for energy saw some gains across the board. So overall, guys, no major red flags. The market is looking a lot more broad than it was roughly 3, 4 weeks ago, and we are heading in the right direction. However, as I said, this week, guys, is going to be a very, very heavy week in terms of the macro, and we'll take a look at that after we do the earnings. So to start off the earnings analysis, as a matter of fact, let's take a look at Texas Instruments. So Texas Instruments on the Friday session coming down about 7.5% after their earnings. They did report very nice numbers for this current quarter, but the guidance was somewhat lackluster. And this goes to show that there's kind of a bifurcation in the semiconductor industry that we've been noticing roughly over the last 2 quarterly earnings reports. You have some companies like AVGO Broadcom, Taiwan Semiconductor, NVIDIA constantly pushing the bar of new all-time highs and coming out with good numbers and guidance. And then you have pretty much everything else, all the other semiconductor companies, which are kind of beholden to the recovery of the personal computing and personal electronics and even auto and industrial vehicle demand, right? We know that that has been relatively weak since 2022. When people had a bunch of stimulus money and low rates, bought all the electronic devices that they could possibly afford. They bought all the cars that they could possibly afford as well. And even the industrial machinery in terms of renewing fleets and stuff like that. All of that was done 2021 into early 2022 when rates were cheap, money was flowing. And now the refresh cycle has taken a full 3 years for these companies to get through an inventory buildup. So now is the time to take a look at whether or not the semiconductor industry as a whole is rounding the bottom of cyclicality. We know the industry overall is a very cyclical one in its nature. When they have boom cycles, these go very well. But then when they don't have boom cycles, when the economy takes a little bit of a drawdown and consumers are not spending so much on electronic devices because they bought them all new 2, 3 years ago, when is the next big boom from that consumer refresh cycle going to come? So we're going to take a look at Texas Instruments and see if we can derive what they've been saying about that. So in terms of their quarterly quarterly earnings here, guys, right? Taking a look, 7.61% beat on EPS and a nice little beat on revenue, but it was all in the guidance of exactly what I was talking about just 30 seconds ago. So Texas Instruments suffers the worst rout since 2020 on weak forecast, referencing the decline of 7.5%. Let's take a look, guys, and this article is extremely important, so let's get into it. Shares declined the most in nearly 5 years after the chip maker gave a disappointing earnings forecast for the current period, hurt by still sluggish demand and higher manufacturing costs. The profit of $1.05 a share for the guidance was well below the $1.17 that analysts projected on average, so share price coming down because they missed the estimate on EPS. Much of the electronics industry remains mired in a slump, contributing to 9 quarters of sales decline at the company. Manufacturing expenses have also affected profit. TXN gets the biggest portion of its sales from manufacturers of industrial equipment and vehicles, making its projections a bellwether for much of the global economy. 3 months ago, executives said some of the company's end markets were showing signs of emerging from an inventory glut, but the rebound hasn't come as quickly as some investors anticipated. While industrial was better than our expectation, management refused to call the bottom as they continue to note an uneven recovery across different subsegments. We've heard this from so many different companies, guys, not only from them, from other producers such as ON Semiconductor. We've also heard this from Micron and a host of other semiconductor names which are largely exposed to end markets, PCs, personal electronics, and especially auto vehicles, whether personal or also industrial and commercial applications. Moving on further, industrial automation and energy infrastructure still hasn't found the bottom, said the CEO. In the automotive segment, growth in China wasn't as strong as it has been, meaning it can't offset the expected weakness in other parts of the world. We haven't seen the bottom yet, let me be clear, the CEO said. So, still not possibly guiding for an actual cyclical bottom for the entire industry, except for the leaders of the space, NVIDIA, AVGO, and TSM, which largely are focused on the data center expansion. If you're not in data centers, guys, you have not recovered if you are a semiconductor company. Moving on further, the Dallas-based company is the biggest maker of chips that perform simple but vital functions in a broad range of electronic devices. The company is running some plants at less than full capacity to reduce inventory stockpiles, and that is taking a toll on profits. Chip makers in other parts of the world have offered a mixed picture of demand for their products. TSM, Samsung, and SK Hynix have pointed to continued strength in data center products, helped by the AI boom, but overall growth is still hampered by downturns in other markets such as smartphones and personal computers. Together, the industrial and auto markets account for about 70% of Texas Instruments' revenue, and those segments have just not been doing too well since 2022. TXN chips also generally don't require state-of-the-art production. Even so, the company has embarked on an aggressive expansion and upgrade of its facilities in the US. While that spending is weighing on profitability, the company says it will move to help lower costs in the long term and help it compete with Chinese rivals. So even though that segment of the business for TXN, well, all segments of TXN's business are in a slump, they are still spending more and more money on improving production facilities and potentially ramping up for supply in the future. But when we talk about this future, guys, it's still probably at least 6 to 9 to maybe 12 and even 18 months away. As the CEO said, he is not calling the bottom just yet on that cyclicality. And moreover, TXN's chips aren't powerful enough to trigger US export restrictions on China. So the article paints a very clear picture of what's been affecting not only TXN, but a lot of different players in the respective semiconductor industry. I will show you what that means on a very easy to read visual chart. Here is the pull forward of demand 2021, 2022. Free money, low interest rates, everybody getting a new car, a new smartphone, a new PC, a new television, and all of that good stuff. And now you can see when rates go higher and people have less disposable income, you can see the effect on the cyclicality of some of these businesses. Very clear drawdown in EPS and a very pronounced drawdown on revenue as well. And we have been trying to find the rounding of the cyclical bottom, but as of right now, the CEO is not willing to call that on himself. So where does Texas Instruments stand in terms of the valuation now that we know the company is facing a few cyclical problems? Well, let's have a look here. Revenue growth for the next 2-3 years is going to be 9.6% per year. Not too bad. And EPS growth about 20%. Now the consensus is mid-20s, but I've dropped it to 20% in the event that the recovery of the cyclical nature of the business takes longer than expected. That leaves them at a $185 price of about a 32 price to earnings ratio on a forward basis. When we divide this price to earnings by the EPS growth rate, we get a 1.71 peg. That is just okay, guys. Not good, not bad, but okay. But if you drop this EPS rate anymore, the PEG ratio is going to be closer to a 2. So that is why Texas Instruments is not a company that I'm looking to invest in myself. I think they're somewhat expensive for the uncertain landscape that is in front of them. And I've been playing semiconductors in a very easy fashion over the last 3, 4, 5 months, knowing that this has been the case for many different companies, guys. It is not only TXN, it's Micron, ON Semiconductor, and a host of other companies as well. So because of that, because we know that consumers and even industrial applications have been weak for a lot of semiconductor components, I'm only playing the ones that are in the best niche of the industry right now, namely the infrastructure expansion for data centers. So I do not want to play any semiconductor stocks that are too exposed to the end consumer. I just do not think they are ready just yet. Sure, if you have a long enough time horizon, could be interesting to play the cyclical bottoms right now, but overall, I'm sticking to the best of the bunch, which for me is TSM, NVIDIA, and Broadcom, quite simply put. So overall, guys, not a bad valuation, but still the company is facing some problems, and if you lose this support level right here, which it does look like the bears might be able to take over here, we're probably heading back down here at about the mid 170s. If I wanted to buy TXN, knowing the problems that they're facing, I really need to get the best possible price. And for me, that would have to unfortunately be down here in the mid 160s to 150s if I'm going to play it at all. So take from that what you will. Those are TXN earnings, and I hope you enjoyed that recap. Now, for recap number 2, we're going to be doing something in a completely different sector, which is going to be American Express. So American Express coming in with their earnings Friday after the close, and you guys know this one has been on a heck of a rally since late 2023. The stock price pretty much over doubling, about 125% to the upside, straight shot to the upside, guys. So overall, with this company continuously pushing the boundaries of new all-time highs, is it still a good value proposition to be buying here at these extended levels? Well, let's have a look here. American Express had a very decent quarter, about 0.39% surprise on earnings and a 0.10% surprise on revenue. So very slim beats, but overall the company is sitting pretty. Now, moving on further into the article, American Express CFO says spending picked up at the year end thanks to millennials and Gen Z. This is nothing new. American Express about 2 years ago embarked on a very large marketing campaign wanting to attract more millennials and more people from the Gen Z demographic because they understand that that consumer base is arguably going to be the future of the company. So they've been doing a very big marketing push for them and so far have reaped the rewards of that marketing push. Let's move into the article. Affluent cardholders got comfortable spending freely again late last year. Very decent quarter for American Express. While the year-end pickup was seen all across consumer segments and geographies, it was especially fueled by millennials and Gen Z users, where transaction volumes jumped 16%, up from 12% in the third quarter. Gen X customers spent 7% more in the fourth quarter, while baby boomers saw billings rise just 4%. So only single-digit growth for older groups, but the younger groups spending a lot more money. Moving on, we had very strong growth from Gen Z and millennials, and that 2 percentage point acceleration gives us a lot of optimism for 2025. Elevated transaction levels have continued into the first 3 weeks of this year. Younger Americans are said to spend more on experiences rather than goods, and that is reflected in the results from Amex. Travel and entertainment rose 11% in the quarter, compared with only 8% for goods and services. The boost in travel came from airline spending, which rose 13%, with spending for business class and first class airfares up 19%. Just goes to show you guys that Amex usually does cater to a higher income demographic, so that is very logical in terms of these airfares. Amex shares fell more than 2% in midday trading Friday after the company reported earnings and revenue that were roughly in line with analysts' expectations. So that's why the share price is slightly down, guys. When you have such a phenomenal rally, you just have to kind of play the analyst game, right? You have to constantly beat quarters in a more and more fantastic fashion, or you're just not going to get the same share price lift anymore as you would when the company was kind of range bound for about 2 years down here, right? Up here, you really need to come out with some substantial beats if you want to see a 5-6% day after earnings. And unfortunately, Amex coming in right pretty much at the expectation was not doing it for Wall Street. Moving on further to the company specific earnings presentation, you'll see, guys, the numbers are actually fantastic, right? Year-over-year growth from December, 9% for total revenues, net income up 12% on the December quarter, and, fiscal year as a whole, guys, 21% boost in net income profit margins. Very, very healthy beat by American Express right there. There's your total billed business up 8%, largely surpassing the past few quarters. U.S. consumers billed business is also up to about 9%. That is very, very solid growth. Commercial also seeing a little bit of an uptick to 4%. And international has to be one of the highlights here, guys. 15% growth year over year for them. Very, very healthy. Worldwide total loans and card member receivables. The number is going up, but not because people are burdened by too much debt, just because they have more and more clients. And I'll show you that. Here's the credit metrics. 30 plus days past due. So even though American Express is boosting revenues from younger consumers, are the younger consumers just unable to spend their money properly and taking on too much debt? Well, actually, no. When you take a look at the statistics, only 1.3% of all clients are 30 plus days past due. Compare that with pre-pandemic levels of 1.5, and you can see we are under the average estimate, or the average historical means. Very good. Net write-off rates, the people who don't have any money anymore and just write it off as a total loss, are they higher than the pre-pandemic levels? Are we heading into a credit crisis? Well, as a matter of fact, no. The banks told us that just a few short weeks ago, and now we have Amex telling us no, their consumers are actually fine. Only 1.9% of all consumers writing off their debt, which is in relation to the pre-pandemic levels of 2.2%. So we are below that average as well. So credit crisis, well, not apparently from the bank earnings and nor from American Express earnings either. And is Amex worried about these two numbers ticking up in the future? Well, no, because they're not putting away more money in the event that that should happen. Here you can see the total reserves for either the 30 days past due or the net write-offs as a whole. So total provision for charge-offs, as they call it, actually down from last quarter and down significantly from Q4 of 2023. So it does show that the company does believe that 2025 should not be a complete destruction of the consumer, at least not when they're looking at the total provisions. And we saw that as well from bank earnings just a few short weeks ago. So all in all, guys, very healthy quarter for American Express, whether you look at the net card fee growth, whether you look at the total consumer acquisition and everything else, guys, and even common tier equity one. We looked at this for the banks, right? This is how well the company is capitalized, because contrary to MasterCard and Visa, American Express does hold the debt. MasterCard and Visa are just network providers. They do not hold the debt. When you look at your card, your MasterCard, it'll say JP Morgan MasterCard or Bank of America MasterCard. It just does not say MasterCard. Who holds the debt for Visa and MasterCard? It is the banks. American Express is different. They are their own bank. They hold the debt. So this is why you see common tier equity one structure ratios here. Just goes to show the ratio shows how well is the bank capitalized in required to regulatory minimums. Here you can see the regulatory minimum for banks and American Express is 7%, and they have well enough above in terms of their capital structure requirements for that. So very healthy, guys. You'd be hard pressed to find anything bad in this Amex report, other than the fact that the company is trading relatively high in terms of its 2-year averages. Moving on into it, guys, the valuation is not terrible, but it's also not extremely juicy either, right? So revenue growth of 9.8 per year, EPS growth 13% per year for the next few years. That leaves us at a 2025 forward P at $321 of about 21. Not the worst, but divided by the EPS growth rate, you get a PEG ratio of 1.61. It's decent. It's not as cheap as it was just a few short quarters ago, but it's also not bad. It's just kind of right there in the middle. Free cash flow yield, though, that's pretty attractive, about 6%. The average free cash flow yield for Visa and MasterCard is about 2.5 to 3.5. So American Express, decent value here. As I said, it's not a tremendous buying opportunity, but is there a problem for putting this in a long-term portfolio? Probably not. You're not buying the best level. You're not buying the best valuation, but is it a terrible buy? No. And quite simply, you can look at the factors of expansion here. EPS should be growing nicely over the next few years, and revenue should be expanding very nicely as well. So all in all, American Express, extremely solid company. But if I had to do this one for a swing trade, I might be looking for a retest of roughly the $300, maybe back down to roughly the high 290s, 280s on a little bit of pullback, because the monthly here is a little bit extended. I would not be surprised if we will get some pullback soon on a technical factor alone. So for me personally, 280, 260 is the sweet spot if I want to add any American Express shares to a long-term portfolio. And that is just how I view American Express earnings. Hopefully you guys enjoyed that. So that is everything for our earnings, guys. Hopefully you enjoyed those recaps. Now, in terms of the SPY, let's get into some technicals, shall we? So the SPY is sitting at a cool all-time high right now, but we have to remember that we are facing a few different events this week, which could move the market in a very big fashion. Take a look, guys. For this week upcoming, we have the Federal Reserve interest rate decision on January the 29th, and I will remind you the consensus is for a pause in the rate cutting cycle. 98% consensus that the Fed will just pause over the course of the Wednesday meeting. That is in line with their projections for the year. Here is the summary of economic projections released December 18th from Jerome Powell and the Fed committee. And you can see here the federal funds rate projections moved from a 3.4 to a 3.9 terminal rate by the end of the year. That means we're down from 4 interest rate cuts to only 2. And unfortunately, January is most likely not going to be one of those cutting events. So the guidance from Jerome Powell, the tone of his speech will be as important as it was in the December meeting. So this could move the markets in a very big way, not from the pause that is already priced into the markets, as you can see, but the tone, his tone on the economy, the direction of inflation, the jobs market, those will all be front and center just as they were through the December 18th meeting as well. Thereafter, we also have GDP coming out on the Thursday session. And then Friday, we have core PCE, another inflation read. So a number of different economic results this week that could impact the markets. But arguably, the biggest of the bunch is going to be the earnings, guys. This week, so many different companies are reporting anything from SOFI, GM, Lockheed Martin, Raytheon, Starbucks as well. But the biggest ones of the bunch, guys, come on the Wednesday session. ASML, Tesla, Meta, Microsoft as well. And then on the Thursday session too, you have some big ones, guys. UPS, Apple, MasterCard, Intel, Visa, just to name a few. And that is pretty much going to wrap it up for most of the big tech earnings, but you're going to have some very large moves Wednesday and Thursday as a result of these earnings. So all in all, it should be a very volatile week for the SPY. So keep that in mind, guys. That being said, we are looking pretty good right now. Nothing much has changed. It was a daily downtrend, big engulfing move. And I was saying if you lose the hourly uptrend, as we are potentially doing right now, right? Big little retracement right here. If we breach the Friday lows into the Monday session, that will be hourly downtrend, significant loss of the 12 EMA, which means we are into daily consolidation. Good thing for us. Tons of space here. Anything above 575 looking for a daily higher low for possible further trend continuation. Obviously, big tech and Jerome Powell will have an impact on whether or not we get a shallow pullback, a deeper pullback, or simply no pullback at all. But I will be a big fan of buying any form of pullback. And as per usual, I will be using my favorite way of doing it, which is writing puts under the market. 602 down to about 595 is your most recent support level. The moving averages are converging there as well. So we will see how this level gets tested, whether or not it gets broken. But one thing's for sure, we're working with a lot of space. Even on the weekly, guys, a ton of space right now. It was a weekly downtrend, big weekly engulfing move. So the bulls have tons of space if they need to pull back, set a higher low, and then go for the weekly uptrend shift. Moving into the Qs right now, the Qs also not looking too bad, about 0.57 down, but very close to the all-time highs. The context, I'll remind you, daily downtrend, big engulfing move, ton of space off the lows to reset into a possible new daily uptrend, which we have not had since the early stages of December. So anything above 500, looking for the daily higher low for possible further trend continuation. You can argue there is a mini level right there, which is kind of in line with these guys as well. So if I just circle this area, it's not a very strong one, but it's the next one we have. Roughly 525 area lines up with the moving averages as well. But the bigger one arguably is all the way down here at about 515 out of 510. So much space by the bulls. We will see what happens, but the Qs definitely will move more than the indexes this week because of all the big tech earnings. Weekly downtrend was in play, big engulfing move. So the bulls do have a lot of space here to set up any weekly higher lows in the event that tech earnings are not well received. Powell is not well received, and we go into some consolidation. Moving into financials now. Financials etching out some new highs on the week, but overall the move is slightly extended, as you can see. The context was a daily downtrend, big engulfing move. Eventually, the bulls will have to reset this into a new daily uptrend, something they have not done so far. No major pullbacks in terms of financials. We've been largely grinding on the 12 EMA, but if you do see a lower high, lower low pattern start to form with a loss of the 12 EMA, you know that the daily move higher is finished. Then we look for the higher low for possible uptrend recapture. Uptrends we have not had since the late stage of November, but the bulls are looking pretty good. Overall, guys, another engulfing move on the weekly, tons of space to set up a weekly higher low for further trend continuation, and the level we could be targeting is down here, 49 to roughly 48. touch of the 12 EMA, breakout, retest, and possibly run. That would be a likely scenario that I'm possibly forecasting over the next 2 weeks of trade. Now that we are largely through most of the big bank earnings, and there's only really 2 big earnings that remain, and they are both this week, guys, MasterCard and Visa. But if the American Express earnings are ever anything to go off of, they should be pretty good. Moving on to healthcare right now. Well, healthcare, we know that healthcare has been one of the weaker sectors in the last roughly 3, 4, 5 months, but they're starting to manifest a nice little turnaround right here. Beautiful daily uptrend. At this point, when this move is topped out, you'll be looking for a higher low. Anything above these guys, 139, looking for a daily higher low for further trend continuation. And if you ask me where we could pull back to, 141, confluence with the moving averages, prior resistance, newfound support. That could be a pullback area for the bulls if ever they get a little bit tired at these current levels. All in all, in the weekly, guys, we are trying to reverse 4 or 5 months of damage, right? So weekly downtrend was very obvious, clear as day. Beautiful move in terms of the bounce size by the bulls. Take a look at the size of the bounce. Size of the bounce, almost 75, 78%. Looking very good, creating a lot of space off of the lows. So in the event we lose the daily uptrend moving into this week of trade, if you were to lose the daily uptrend into a daily downtrend, understand what we're looking for here. Just looking to reset the weekly higher lows into a brand new weekly uptrend, something we have not had since the late stages of the month of August. So we have to keep our eyes peeled for healthcare because they've been weak and they are one of the biggest components of the S&P. So if they choose to rally, they will maybe perhaps reduce a lot of the impacts of the tech earnings and maybe a financials pullback over the course of this week. So keep your eye on that sector rotation. Moving on to semiconductors right now. Semiconductors, guys, I mean, I'm hesitant whether or not to close this weekly box green because we did close above it, which is what I've been saying that we've been watching out for the last, 3, 4, 5 months of trade, but we did not break it in a significant fashion. We did close above it, but not by a very wide margin. That being said, daily is in a very nice daily uptrend, looking for a new daily higher low for possible trend expansion. That being said, this whole area, at least on a temporary basis, 260 down to 250, now that we've officially closed above on the daily, can be used as support as a whole. But overall, the weekly is not looking the best, right? In the event that big tech earnings are just not well received this week as a whole, what do you guys think is going to happen? We're probably just going to pull back down into this range, so I'm not going to turn this box into an overall support region just yet. That being said, the bulls did clear the level, but not by very much. So yes, we can be looking for the breakout, the retest, and run trade, but it's not looking like the most solid breakout, retest, and run trade because we've only marginally increased the levels right there. Weekly uptrend, yes, is nice, but any pullback will be looking for a higher low into higher highs. And I'll remind you, my favorite way of playing these pullbacks is writing puts on my favorite companies below the market. And this week, I might just be targeting NVIDIA to do that. And we'll take a look at that later on in the video. MACD on the weekly, notable cross, but the job is not done yet. We really need to see the bigger breakout play out here to be secure in the fact that we can actually use this area as some larger support for a big pullback. Moving on to the Russell right now. Well, the Russell reacting not too poorly on the Friday session, but hasn't really moved since the Tuesday session either. The context was a daily downtrend engulfing move. Now the bulls are looking to set up the higher lows and go for the daily trend change, something they have not done so far just yet. On the weekly, we're kind of fairly mixed as well. It was a weekly downtrend, nice engulfing move, but we're kind of struggling with resistance here, 231 down to about 225, and that's previous resistance coming all the way in from 2021. That being said, guys, the Russell is pretty much trapped in some form of a range between this support, this resistance level and the support below us, roughly 215, 208. I'm not looking to position in this one myself just yet. I think there's a little bit too much risk to say that the broad market risk on trade is here. But in the event we retest these levels down there, I might be looking to position right now. I'm not looking to go for the index as a whole. I'm going to play certain names here and there, but overall, the Russell remains somewhat of a muted trade. Moving on to the Dow Jones right now, too. So the Dow Jones is not looking that bad, guys. 0.32% down to the 0.32% down on the Friday session, but all in all, gorgeous engulfing move. Daily downtrend into a massive one-time engulfing rally. And now, guys, the bulls are getting a little bit extended on higher time frames. The hourly was overbought, coming down a little bit now. You can see we are barely losing the 12 EMA. We will need to see, is it going to be a case of an hourly downtrend? If you see that, suffice to say daily consolidation is underway. Could be lasting for 1 to 2 to 3 days, but any longer form consolidation could get us into a daily downtrend, but that will be fine, guys. Even if we pull back a lot, it would be fine because we have so much space off the lows. Anything above 42,000 is looking for two things: daily high or low for possible uptrend. But if they cannot get it done and we go into further extended consolidation, just remind yourself who is trying to reestablish control. Weekly downtrend, engulfing move, we would just be looking for a weekly high or low for further trend continuation. So the support level for me has to be down here, 43.3, all the way down to roughly 43,000 flat. Retest of the moving averages and retest of the prior resistance, which is now support area for the market. So even if we do embark on a few weeks of consolidation, the bulls have created a ton of space off the lows to give themselves the best chance of re-getting the weekly uptrend, rather, something we have not had since the late stages of November. That's it for all our major indexes rundown. Now let's go into some of the minor sectors, and I'll just do these very, very rapidly. So XLP, big daily move down, guys. The bulls have a lot of work to do here. The daily looks nice for a daily uptrend recapture, but similar to healthcare, need to do the full recapture on the weekly as well. So although it does look nice on the monthly too, nice breakout, retest of the prior resistance range, these could take a little bit of time to really start getting their momentum back. And some of the biggest players are going to be Walmart and Costco. Those have largely been doing okay, holding up the rest of the industry, but a lot of the bigger names as well, names like Coca-Cola, Pepsi, the tobacco companies, a lot of them have been kind of lagging behind as of recently. So I couldn't say that the broader market is doing a good job of pulling up the sector as a whole, but some of the biggest names have been holding up gains better than others. So XLP could be an interesting trade into 2025, but as I said, it's going to take a while for that momentum to come back. Moving on to utilities. Utilities had a nice little rally since hitting the bottom of essentially hitting the top of yields, which was the bottom of bonds, which carries into the utilities trade as well. Nice bounce off the bottom, looking for the daily uptrend recapture, and the weekly lows are set pretty nicely as well, looking for the weekly trend expansion right here, and just the monthly breakout retest, right? Monthly uptrend, breakout of this resistance range from 2022, breakout, retest, and possibly rally for utilities. I am mixed on utilities. I don't really like playing utilities because they move so slow, but the sector could be doing well because interest rates will probably be coming down over the course of the year. They'll stay higher for longer, but I don't believe the Fed is going to embark on a rate hiking cycle. A lot of speculation around that. We'll see if it comes, but overall, utilities, not my favorite sector, but I'm not going to lie, the chart does look good for a little bit of expansion. Moving on to real estate now, same thing as utilities, really beholden to the direction of interest rates. Monthly is a breakout, retest, and possibly run, bottoming out nicely in the support zone, 41 down to 39. And similar to utilities, the bottom of this was really the CPI report, which kind of topped out yields as a whole. So we're looking for the daily uptrend recapture. Not that bad of a trade. I've used these recent drawdowns to buy one of my favorite REITs as a whole, which is Vici, but you can see the chart on Vici is just kind of very, very muted and has been muted for the last 2 years as part of the rate hiking cycle. A lot of these real estate companies, guys, are going to struggle to really hit new all-time highs until we have confidence that rates will be coming down and that inflation is no longer a problem. Moving on to energy now. Lastly, well, energy is not doing too bad as a whole, guys, coming off of a tremendous rally from the month of December, guys. And it's not really because of any of Trump's policies, contrary to what people believe. You can just look at oil seasonality. I mean, yes, there's tons of geopolitical things at play here, but overall, oil for the past 30 years, arguably, has had the exact same seasonality. Mid-December, late December rally, January and February could be a little bit flat, and then we resume an uptick in the prices of oil for the resumption of consumption. People traveling more, people using their cars more out of winter, and agriculture also season starting in the northern hemisphere of the planet, of course, right? So there's your oil seasonality, and overall you can see it's kind of manifested so far. So the gains here, January, February, could be a little bit muted, but if you just follow the seasonality chart, the oil companies could be having a little bit of an uptick there as well, as they do every single year, of course. Foreign policy and domestic policy will impact this as well, but I think seasonality should play the biggest portion in your analysis if that's something that you like playing. And that's pretty much everything for our minor sector analysis. Let's move into the VIX. The VIX, I mean, has been left at historical lows, but we know sometimes that when the VIX has come down off of these highs, it's just waiting for a catalyst. And this week has many catalysts. I'll remind you, it has Jerome Powell on the Wednesday session, which led to this increase in the VIX on December the 18th from the lows. And we also have a number of big tech earnings too. So if those go negatively for the market, you can expect a spike in the VIX. But overall right now, decent level. I'm not a buyer of the VIX down here. The VIX I just use for how aggressive I want to position in trades. When we are at fear highs, the markets are usually somewhere near local bottoms, and that is when I want to buy the market. But when we're low on the VIX right here and high on the markets, that's when I want to take profits and be a little bit more picky on the plays that I'm using. And moving into yields right now. So the 10 and 20-year yields have arguably the same chart, right? Nice sweeping move on the daily to the downside. We're looking for the rollover, which could be a picture perfect Picasso style drawing from me of a head and shoulders. So we'll see how those operate over the course of the week. Obviously, Jerome Powell's speech on the Wednesday session will probably impact the direction of those longer term yields. And that is probably the only thing this week which will have that big of an impact. So we'll see if they're able to get the daily downtrend on the 10 and the daily downtrend on the 20-year yields as well. They can move down, guys, but sometimes the move down from highs takes a while, right? It does move down, but it moves down very slowly. So we'll keep an eye if we're able to come down further and eventually set up the weekly downtrend, similar to exactly what we did back in that period back there. How it translates into bonds, the exact same thing, right? We're eventually possibly looking for the recapture of the weekly uptrend, but bonds move very, very slow, guys. So if we're looking to kind of pick the bottoms here, I do see a trade on TLT. The entry would be about now, and the stop loss would have to go below the CPI lows, which is just below the $85 mark. Because if not, guys, I mean, it just invalidates it, and we're heading lower, and we're possibly heading a little bit higher on the 20-year as well. So just keep that in mind. Not opposed to taking a swing trade on bonds, but we have to play these with the stop loss, because if it gets taken out, we know how long these take to recover, right? So that is pretty much your entire analysis of the overall market. Hopefully you guys enjoyed that. Now let's move into some crypto and then some big tech names. So Bitcoin overall, guys, I mean, I've been saying it, right? Bitcoin traders are getting a little bit impatient because they want to hear the news from the strategic Bitcoin reserve, and they're just not getting it yet. All that being considered, though, Bitcoin really is doing a great job of upholding the all-time high levels right now, struggling with the overhead resistance 107, but I see no red flags on this chart. That would only come if we break 99. That would be a clear loss of the daily uptrend and could hint to a little bit further weekly consolidation. The weekly, though, is looking nice. Weekly uptrend, looking for higher highs, which we got, although temporarily early on in the week. Not too bad, tons of space, anything above that 88, looking for a weekly higher low for further trend continuation. So Bitcoin overall looks good, but it is heavily catalyst driven right now from anything that comes out of the Trump administration. And of course, coming from the overall strength of the economy, right? We know that Bitcoin is part of the larger risk on trade. And so far, risk on assets, yes, they've been doing okay, but they have not really had the lift that people have been anticipating. And you can just look at that as a proxy with the Russell, right? If the risk on trade was truly front and center on everybody's minds, we'd be somewhere up here on the Russell right now, and people would be piling in on small cap growth and on the risk on trade. But the atmosphere right now is not so clear. So we'll have to take this one day and one level at a time. But Bitcoin's not looking too bad. You can say the same about Ethereum. Ethereum has been doing not so poorly as of recently, but still unable to really break out to the higher end of the range, which is roughly 37 to about 4K. So kind of trendless on Ethereum right now, but the one good thing is we're not breaking below support, 32 down to about 3,100. If we do start breaking support, I'm a big fan of buying ETH in the high 28, 29 levels. Right now is not a bad proposition, guys, but just keep in mind that if Bitcoin doesn't start its exponential rally, none of the rest of any of these altcoins are going to really go anywhere, as you guys have seen over the past 1 week of trading. Take a quick look on the Bitcoin dominance. And if you want the altcoin rally, guys, anything other than Solana, pretty much, if you really want to see the big altcoin rally, you need to see some big moves down on the dominance chart for Bitcoin. And so far, that just has not been materializing. As I'll remind you, this chart does not require Bitcoin to go down. It just requires Bitcoin to stay flat, go up slow, or go down slowly as well. And these altcoins need to go up a lot faster. And in my experience, the crypto bull market, the crypto market as a whole, they will not want to bid these altcoins unless you see a clear Bitcoin leg of expansion, and that will carry into the altcoins in my humble opinion. Now, moving on to our big tech name, shall we? Moving on to Apple. So Apple down about 0.39%. I mean, they have earnings this week, so it's going to be very tough to derive any short-term price action levels. We'll go into the expected moves as we get closer into the week, but with only 4 days of trade, guys, it's really tough to derive any price action levels for Apple. Daily downtrend is clear as day right now. If this is the lower high, and we possibly take that as the extent of the size of the bounce, because we know they had the hourly uptrend. We've now lost the hourly uptrend again into the end of the week. It's not looking good, as if anything, it gives the bears a very good chance of flushing the 219s and going to flush the utmost lows of the support level, which are at 215. If that does happen before earnings, guys, it's not going to set up Apple very well. If anything, if earnings are underwhelming, we could honestly be heading all the way down here, 205 down to 200. That is my buy zone on Apple, guys, just because we've lost all of this momentum. I understand we are holding support for now, and I understand earnings could give us a temporary bounce, but you have to understand Apple right now is trading very, very rich for a company that is expanding revenue at only 5% per year. This is the weakest of all the Mag 7. Their earnings have been flat for roughly the last 2 years. You know, they're bolstering their share price with buybacks, and the valuation right now is extremely high at a 3 peg, trading around $222. So I'm a big fan of buying Apple, but my actual price target for buying Apple is down here, 205 to 200. I have some long-term shares that I'm not willing to sell just yet, but any new positions or trading positions, I need to see Apple get absolutely crushed. And as of right now, it is down from the all-time highs. We were looking to play a bounce, but after the bounce, guys, we're not too sure if we're just going to struggle around here because of the heightened valuation. Now, moving on to everybody's favorite stock, which is AMD. So AMD, unfortunately, down 0.16% on the day on Friday. And as a whole, guys, the stock is not just looking strong at all, right? We know the context is a sweeping monthly downtrend. We also know it's in a sweeping weekly downtrend as displayed by these legs right here. So in all reality, guys, the daily bounce either is, okay, but nothing is going to be amazing about this bounce. It's a 618 bounce. Usually, if you want to have an amazing bounce, it's a 782 or 100% engulfer. Right now, at 618, guys, in the context of a monthly downtrend, a weekly downtrend, the bounce is okay, but nothing to scream home about. We're currently rejecting from resistance 123 up to 135, and any moves lower will most likely see us revisit the lower ranges of 114. Now, I'll remind you guys, the thesis for AMD, some people love this stock, some people hate the stock. We will see what they have in store for us because they do have earnings in the next 2 weeks. They're growing EPS and revenue at very attractive clips, but this is a company that's had the same problems as we just reviewed in TXN's earnings. The consumer segment of the company is not doing too good. What is doing good is the expansion of their data center business, looking to take second place to NVIDIA's Blackwell chips. Now, that being said, guys, I'm not opposed to playing AMD, but I need a bit more of a discount. If we do drop a little bit more and come closer to the 113 down to 100 area of support, I do think it'll become very, very deep value territory. So the way I'm playing this one, quite simply, is writing short puts under the market. And for me, I'll be targeting 110 to about 105. I'm still unsure whether or not I want to play this one before earnings. I might just wait to see what happens after earnings, and then I'll resume playing my short puts on this one. For now, I'm staying with NVIDIA. Moving on to Amazon right now, down about 0.24%. Not the best, not the worst day for Amazon, just consolidation towards the all-time highs. Amazon is looking extremely strong into its earnings in the week of February the 5th. So no earnings this week for Amazon, but in 2 weeks' time. This week, it could respond to other institutions' earnings because a lot of emphasis will be put on the growth factor of the cloud business. So we'll get more information on the growth of respective cloud businesses from Meta, Microsoft, and especially Apple. So Amazon could respond to that in tandem. Moving on as well, daily, very nice. Well, this was a daily downtrend, beautiful engulfing move, looking for a higher low. Anything above 215, looking for a daily higher low for further trend continuation. And the pullback area, in my opinion, is 230 down to 225. Maybe breakout, retest, and run. We'll see, though. It could be affected by big tech earnings. The weekly looks fantastic. Has been a sweeping weekly uptrend this entire time. Although we lost a little bit here, it was somewhat of a weekly bull flag. Very shallow and muted pullback into the 12 EMA, and now we get the expansion, but it is beholden to earnings. The company's fundamentals are still fantastic at these prices, so we'll see what happens for earnings, but Amazon, probably still one of my favorite picks for 2025. Moving into Google right now, Google as well, holding above close to the all-time highs. Daily uptrend is clear as day right now. We set the daily higher lows into this guy right here, 196, and now possibly looking for some expansion. Google as well, no earnings until Tuesday, the 4th of February, but it will be affected by other big tech earnings over the course of this week. So Google's price action could be a little bit difficult to determine because it will be impacted by those respective earnings. But right now, looking great, daily uptrend, looking for the expansion, and weekly as well is currently in a nice weekly expansion uptrend phase. with the higher lows sitting poised around 187. If I can find Google over the next 2 weeks because of earnings, because of Powell, because of whatever, 180 or below, I would be a big fan of writing some short puts, but I did open a new leap call position at this area. And I played it a bit more carefully than normally, and I'll be showing you that just in a, about 5-10 minutes when we go over the portfolio. But Google's valuation right now is excessively cheap, in my humble opinion. The company's still trading roughly around a 1.43 peg, around the $200 mark, which is cheaper than all the big tech companies out there. Moving into Meta right now, Meta eclipsing the new all-time highs, clipping into the 650 area of psychological resistance. That being said, Meta does have earnings this Wednesday, so the expected move, we'll take a look at it over the course of the week, but suffice to say, Meta's looking pretty right now. Daily uptrend is clear as day, eclipsing the all-time high levels, so it could just be due for a little bit of a breakout, retest, and run, but we know it won't have time to do that before earnings. Earnings on Meta usually moves about 6-7%, so if they have bad earnings and they start from here, could just get pulled back into this consolidation range, support area of which is 597 down to 583, and if they really blast off after earnings, guys, suffice to say that we have a very good chance of maybe heading all the way up to the 700 psychological area of resistance. So we will see what happens with earnings, but I'll give you guys a closer glimpse as we approach the earnings date, and I'll give you more projections and predictions and how I am looking to play this stock. Moving into Microsoft right now. So Microsoft down about 0.59 today, but Microsoft has had a very good week overall. Daily downtrend into a very nice reversion and daily uptrend formation right now. In the event the bulls are getting tired up here, maybe they have to pull back on the hourly time frame. Keep an eye on the losses of 441. That will be hourly downtrend, loss of the 12 EMA in a significant fashion, and could just be due for daily consolidation. That being said, though, they have earnings coming up on Wednesday, so not too many more days, guys, to get some short-term price action in. Microsoft usually moves about 4% after earnings. So if earnings are bad and we start from here, could come down into this previous resistance range, which I'll now gladly turn into support because we did close a weekly candle above there. So let me turn it green once again. It could be using this area as support if we pull back into it. And if Microsoft's earnings are very bullish, probably eclipsing some of the recent highs and maybe even moving on to new all-time highs around the 465 region. So Microsoft looking very good, a year's length of accumulation. If they show good earnings, I would not be surprised if we are due for some weekly cycle expansion there, looking quite strong. Moving on to Netflix right now. Well, obviously Netflix had a tremendous week after their earnings. So the downtrend was clear as day. And now the bulls, of course, putting in the massive earnings engulfing move. If we do pull back because of overall maybe bearishness from Powell or bearishness from other tech earnings, could be coming back to the support range, which is 932 down to 900. A little bit of a breakout, retest, and possibly run. We'll see if they get there. And if Netflix has a great week because Powell is okay and big tech earnings are good, we could be looking to expand beyond the $1,000 mark. And at that point, it's full price discovery. You have to go with psychological numbers such as 1,050 and such as $1,100. I'll remind you from the earnings last week, the valuation at $1,000 was okay. Not too expensive, but not also cheap. So if we're building a long-term portfolio, it's okay to DCA some shares with every paycheck if you want to, but starting a massive position on Netflix up here, maybe not the best risk to reward. I'd be keen on waiting for maybe a little bit more of a pullback in the event we get it, 900 or below. Moving on further, guys, to NVIDIA. NVIDIA also, had a great start to the week, but on the Friday session came a little bit undone, 3.12% to the downside. And this is kind of like the semiconductor as a chart as a whole. We were looking for the breakout of this 3-4 month range. We almost got it, and then it kind of came undone. You guys should be used to it by now, right? A couple times it's tried to do this, and a couple times it has failed. That being said, nice sweeping move to the upside on the daily, looking for a daily higher low for a possible new daily uptrend into a second attempt, at least this time around, at breaking through those all-time high ranges. But all that being said, guys, if NVIDIA pulls back even more this week, Powell, tech, semiconductor broad weakness, or something like that, I'll be looking to write short puts the same place I've been writing them for the last 3-4 months, lower 130s. 130 down about 125 is my sweet spot to pick up more shares of NVIDIA for a swing back to the range highs. Just been playing this one, not willing to call the breakout capacity for NVIDIA just yet until we actually get a weekly candle close above 150. So far, we've not gotten it, so we just stay a little bit range bound. Ranges are perfect for playing short puts. So my first entry is here, and my second preferred entry is 120 down to 115. But all things considered, guys, NVIDIA holding up well, close to the all-time highs. Moving on to Tesla now. Tesla down about 1.41 leading into their earnings, guys, Wednesday the 29th. This is going to be a very big show me quarter for Tesla. Why? Well, because we've literally 2x the share price since their last quarterly earnings. So everybody's focus will be, is the 2x in share price warranted because of the expansion of the company's fundamentals, or was it just entirely hype because of Elon's close relationship with President Trump, possible deregulation for full self-driving applications, and stuff like that? It's not as if the company has 2x'd its fundamentals since last quarter, not even close. As a matter of fact, as we just saw from TXN earnings, people are still struggling. The auto markets are still struggling to post year-over-year gains, and I think largely for Tesla that will be the same. Most of this move comes from the forecasts and extrapolation of the company's robo-taxi business in the future. Now, I, as well as a Tesla shareholder, am very bullish on that proposition, but to say that we have pulled forward all of those numbers in one single quarter, I'd be lying if I told you that's the case, right? So that being said, Tesla's sitting nice right now above support, 408 down about 380, but we know Tesla's probably going to move about 10% on earnings. At least that is the expected move for now. If you don't believe me, we can go on bar chart and you'll see the expected move for Tesla is going to be somewhere around 10% without even looking at it. It usually is. And as you can see, the expected move about 8% up or down, so very close to 10. So 8%, if we start off from here, 8% flush would put us below the level support and retesting 350 to 330, and 8% beat to the upside would put us right back towards the new all-time highs, which would be all the way up to about, let's call it between the 440 and 450 region, close to the all-time highs. So going to be a show me quarter for Tesla, guys. I would be lying to you if I knew which way this one's going to go. I'm leaning towards bearish because to get the lift, the company's really going to have to blow everything outside of the water. And we know when they gave us their deliveries numbers earlier on in the month of January, they weren't all that fantastic. So can they convert those less than fantastic numbers into insane EPS and free cash flow and margin growth? Debatable, right? So we'll see what happens, but in the event Tesla does come down, I will be looking to write some short puts, possibly, let's say 350 down to 340, 330, as low as I can possibly get to benefit from that share price decline. But we'll see what we can get, guys. In my opinion, it can go either way. It all has to do with free cash flow and margin expansion for the company because the robo-taxi projections are just too far out in the future to model them with any form of accuracy right now. And I'm saying that as a Tesla shareholder, guys. Just got to call it how it is, right? Moving on to Palantir right now. So Palantir doesn't have earnings until 2 weeks' time, and they did have a very nice day to start off the day, but pulled back a little towards the end. The bull's getting a little bit tired. That being said, we are above, reclaimed an area of support. 77, roughly down to about 75 is the temporary location. It's not a very strong level, but it is a level. And below that, arguably a bigger one, is 72 down to 70. Daily downtrend, nice engulfing move by the bulls. Now it's up to them. Can they set up the daily higher lows and go for the daily trend change? Not that many trading days left before their earnings, so we will see. Can they shape up nicely? You would like to, Palantir, before earnings, you would like them to hug closer to their highs, because if ever growth is not what people are expecting, at least they have a very wide cushion for the downside, right? And if growth is what people were expecting, you're very close to the highs and you can break out in a very decent fashion, right? So Palantir remains a little bit mixed for me. I'm not going to play it much before leading into their earnings. I think it's just way too much volatility before then, but the chart for what it is, it's looking very good. Weekly uptrend clear as day right now. The higher lows are set down here at about 64, and we are looking for the weekly trend expansion. But as I said, before earnings, it may be a little bit tough to put in some big moves to the upside or big moves to the downside. Largely, people may just be waiting for that earnings, and that is on Monday, the 3rd of February. So only 5 trading days left. And now lastly, SOFI. SOFI down about 0.61%. Not the worst day for SOFI, but keep in mind, they have earnings, guys, literally Monday morning, right? So Monday morning, SOFI has earnings. You can see it right about here. That's the wrong page. SOFI, right before the open. So I'll remind you, the expected move for SOFI, will not remind you because I didn't say it so far, but the expected move for the week is roughly 11.5% either direction. So it's going to be a very big move either way, guys. If you get the downside crush, well, you're coming right back down into support, which could be viewed as simply a breakout, retest, and run. I do not think the company is going to post bad earnings. I think their earnings are actually going to be very, very good. However, keep in mind the company in the most recent 2 weeks is up 35%. So Wall Street can use any excuse to possibly drop this stock and say, well, the earnings move was already priced in, right? As a matter of fact, since last quarter, the stock is up tremendously from the bottom, right? They're up roughly 82%. So another show me quarter for SOFI, and they can use any justification to pull it back down, but it would just be looking for a weekly higher low for possible further trend continuation. Nice support here, 16 down to about 13. If we pull back hard into there, I will be a buyer, possibly looking to load up more short puts in the lower $15 to $14 range. But if they crush it, guys, 11% to the upside would mean that we are going to hit one of my temporary price targets, which is the $20 range, and just look for share price expansion. I will be covering the earnings for you on the channel Monday after the close, but suffice to say, it's very tough to say which one this is going to break. You can make an argument either direction, and you'll be able to find a justification for the reason up, for the reason down. One thing's for sure, I think they will have a fantastic quarter just for what it's worth in terms of the numbers, and I think the guidance will be quite good. You only have to look at the legacy banks and the credit card issuers that have reported so far to understand that the banking sector is or had a pretty bullish Q4 and are having very good guidance for 2025. So those are my thoughts on SOFI. And now that is pretty much it for our market recap, guys. Hopefully you enjoyed that. Now let's jump into some of the trades that we made last week, and I'll show you which one of these I'm positioned in for the next week of trading. So we're taking a quick look at the recap, guys. Before we get into the portfolio, you'll see a number of trades were closed. A lot of wheel trades, very successful wheel trades this week. Wheel trades, 6 wins, no losses. BITX, very easy play. The drop on Bitcoin early on in the week. Entered this play for about 30 cents, held it to the end of the week. Worthless, 0.5% achieved, very nice. TSLA, early week dip on Tesla as well. Played the 22.7 puts. This is Tesla 2-time leverage, and I love playing it down here in the lower $20 range. So early on in the week when we had the Monday dip right here, or the Tuesday dip rather, I chose to rote all the way down there, and it was a very profitable endeavor for me. I'll be a little bit careful on these this week though, because Tesla does have earnings. Elf Beauty, the 115 short puts, we got them at 65 cents, closed for 37 cents, guys. This is just because Elf Beauty was showing a little bit of signs of uncertainty throughout the midpoint of the week. So I did on the Thursday session here on the little pop, I closed the 115s and I reset lower at the 107s. I'll show you guys that trade in just a few short moments, but didn't like the way the chart was moving. So I chose to roll down, lock in some gains and write even lower, moving the strike down a full $8 or roughly $800 total, right, on the exposure. Apple, same thing, 222.5 was looking for the bounce. We got in at 114 and we exited the trade at 75 cents. We got into this Apple trade all the way back there. We were all the way down here. It came into us early when we had the Thursday pop. I chose to close the trade because we were a little bit too close for comfort. Coming into the week of Apple earnings, I did not want to hold this trade into Apple earnings, being assigned and writing covered calls. I'd rather just take my money off the table and maybe even reset lower. So we closed this at about a 35% profit. Gains are gains, guys, especially in the face of uncertainty. You don't want to overstay your welcome in the face of earnings. NVIDIA, this was a longer duration trade. We got into this one a few short weeks ago. $612 was the premium received. Closed it at $2.75. 55% win, pulling forward left, $350 something like that. Very, very juicy trade right there on NVIDIA. Now I have all my buying power back and we'll be looking to play some NVIDIAs in the lower 130s and AMD as well. 115s, we wrote those about a week ago for $1.90, pulled forward a lot of premium this week on the bounce. 0.6 was the close, so pocketing roughly 2% in just about a week of trading, a week and a half of trading, so largely within our minimums. Very good trades there. Uber as well got called away. You guys remember me being assigned on Uber a few weeks ago, December 13th, as a matter of fact. We've been in this one for 6 weeks and just closed it. Here are all the assignment covered calls that we've been running. Showed you guys these a few times in a row. All in all, that brought our cost down to about $63.42, and now we just got out at $66 per share for a total profit of $258, or roughly 60.65% per week, above our 0.5% week minimum. So those were very good in all reality. Microsoft directional trade call debit spread that I held all the way since November, guys. Closed the last one. You remember I opened 5 contracts, was closing them periodically as Microsoft was hitting highs. We just closed the last one for a very juicy 56% ROI. And then there's some lottery trades, the earnings trades, the 2 standard deviation trades, right? I showed you the UALs. I showed you the Netflix trades as well. All in all, and the Johnson & Johnson small loss that we discussed too. All in all, 2 wins, 2 losses. But when you tally up the dollar amounts, we did have more profit than not. But I keep these earnings trades small because in all reality, they are only lottery trades. They are not part of the larger strategy. So that is it for the trades that we closed this week. Very decent week, and I have tons of buying power. Let me show you. So here's the YouTube portfolio, guys, and I'll remind you, if you're new to the channel, we started this portfolio 2 years ago. 2023, we made, on the YouTube channel, 75% annualized ROI, and last year, 2024, mid 60%, about 65% ROI, mostly using the wheel strategy and a combination of some leap call options and small account strategies. It's been 2 very good years so far. We used to have about $95,000 of equity in the account in terms of the cash, and this year I chose to show the balance and start with a reduced balance to show what we can do with a more manageable sized account. I know not everybody has 100K, so I cut it in half to start off the week, starting off with about 47,000 balance, and we're up so far on the year, roughly about almost 10%. You can see that right here in terms of the performance. We're up a very cool, roughly year to date, we're up roughly about 9%, just over 9%. So very solid trading session for us, and tons of buying power leading to earnings, which is exactly what I was trying to do. Have maximum buying power leading into this earnings season, leading into the volatility catalyst. So here's the remaining trades that we see in terms of the new ones that you guys maybe are not used to since we've tackled this one on the Monday. ARKG. I have leap call options on ARKG. I think it's one of the stealth plays for AI recently, which is medical applications for AI. I put a ton of time on these contracts, one with in the money on the Jan 27th for about $770, and out of the monies for the June 2026 $35 calls. I think ARKG has been bottoming for about roughly 2 years at this point now. So if we do get a little bit of an AI rally in terms of medical applications, I think this one could be a very good asymmetric bet trade. We bet small, going for very cheap prices, and if we see some expansion, it could be a very juicy proposition. But as I said, I went very small because it's an asymmetric bet, right? It's not as if I'm betting on Microsoft. You're betting on the recovery of an entire sector overall, but still one of my favorite not very often talked about AI plays that could see some potential in the next roughly year and a half worth of trade, which is why I put so much time on these contracts. Other than that, you guys didn't see the CLH short puts as well. We have some CLH 22 short puts, a little bit of a gamble for me. CLH has been down for so long, so I choose to play it in the lower 20s. I think fair value is right around $20. So we went with the 22 puts for about 2 weeks away, 17 cents. So we'll see what happens with these. Or sorry, we got an average price of 19 cents. Let me just change this around ever so slightly here. I'm going to put the average above the last traded price so it makes more sense, so I can go left to right. Other than that, guys, here's the new ELF 107s. I swapped down from the 115s. They're underwater right now, but ELF is not under 107. I don't mind taking assignment at 107, but they do have earnings in 2 weeks' time. So I like ELF in or around the $100 range, and I'll keep playing it there, but I'm playing it light with only one contract. Moving on further, I opened a new Google Leap call trade, but not what you think. It is a call debit spread. So I got the 180 to the long side and capped it with a 250 short call to the short side, of course. Total net cost of the trade is about $2,800.60. The logic is very simple, right? You guys know that I had the last Google Leap around the 157, and we've ridden it since the 157 and closed it up here just a few short weeks ago. Now, I do still want to be exposed to Google longs for the year because I think they'll do well. They're pretty cheap, but let's be real here, right? We're not getting the best levels. We're all-time highs, and we are before earnings. So that's why I'm not going full YOLO with pure straight calls. I'm going with a debit spread because it mitigates the risk to the downside a little bit. It's cheaper entry and is a more forgiving trade overall. So I know I'm not getting the best level. I know I'm buying close to the all-time highs, but I still want exposure. And you can see there, June 2026, I have a year and a half worth of time. So I'm playing this one a little bit more defensive than usual, but that is the logic behind the trade. Other new trades that you may not have seen, the Intuit bull call debit spread, 620 versus 630, just looking for the expansion of some levels, right? Finding a base of support down here in the lower $600 range. And I'm just looking to play the recapture of the up end level on this company. So we have a lot of time on that position too. Those are due for April. So giving myself a good 3 months for the company to get its act together. The rest of the trades I'm not going over is just because you guys have seen them before, right? The KOs are still there. The K-Webs are still there for the China recovery trade. Ton of time left on these. I still have some Microsoft call debit spreads for March, 440, 445, which I'll keep into earnings. They're up nicely right now. 125 total gain, but you can't see the spread price right now, unfortunately. Other than that, guys, I'm carrying a few things into earnings, namely some SOFI $16 short puts. We'll see what happens with those. I don't mind buying SOFI at 16, but just looking to play earnings on this one a bit aggressively, I will add. This is true, but we'll see. I don't mind buying another 100 shares of SOFI down there. We'll see if I can get that entry again. I also went with a SOFI bullish earnings play, which you very rarely see me do, but I went very small, guys. Look at this, September calls, right? $15 calls in the money and $20 out of the money calls, staggered them. Total cost of the trade is roughly, let's call it $1,200. So, you know, across a 50K portfolio, it's not a very large position because it is a speculative bet as well. I'm buying SOFI literally right before earnings at the all-time highs. I was hoping for a little bit more of a pullback into earnings, but I just didn't get it. You can argue that here was the best place to take the trade. This is for sure. But here, I'll remind you, we were kind of heading into CPI, heading into bank earnings, and we were not sure what we were going to get, right? So I was possibly looking for lower levels or a recapture of the entire level to give me confirmation, okay, at least if we do dip, we have support below us, right? So it was either down here or the breakout retest trade. And unfortunately for me, because I'm getting a worse price, I'm going for the breakout retest and run trade. We'll see what happens for SOFI, but that's why I went small. Same thing for the Googles. I know I'm buying them at 52-week highs. And because of that, I'm just not going heavy. I'm going to let the chart do the work and have until September to see whether or not I'll be right or wrong with these SOFI trades. Moving on further here, guys, that's pretty much it, right? Still got the waste management trade, and these are square calls, which we've held now for the past 4 months overall. We're doing nicely. We farmed some covered call premium on them, as you can see down here. We farmed the heck out of these covered calls. They're almost worthless coming into the end of this week, so it helped us reduce our cost base a little bit. I'll remind you, we already took profit on 2 of those contracts at the highs of the move, closing them for respectively 3x the gains and 4x the gains all the way up here. So I'm happy riding these 2 remaining contracts. I have 12 months remaining time on them, and they're still overall up roughly 2x on the remaining 2 contracts. So I'm looking for the Bitcoin expansion, the Square expansion over the next 2 quarters. So that is the full portfolio rundown. As you can see here, guys, I have a ton of buying power, not that many positions remaining. And the ones that I do have, guys, in terms of the market value, you'll see there's no real big trades to be seen at all, right? The biggest one in terms of exposure is arguably Elf Beauty, the only remaining wheel, the big wheel trade that I have put on for about $11,000, $10,000. Other than that, very small. I'm keeping all the buying power to buy these big tech dips if I can find them over the course of the week, and anything else that pops up, mind you. But as per usual, guys, when we head into large volatility, same thing as early January, on the SPY and the QQQ. You remember I had tons of buying power, deployed a lot of buying power here, made a bunch of money. Now we take that buying power off the table, leading to the next volatility catalysts. And if we get some dips, I will be loading up to buy those dips again, because the overall the bias is bullish for the markets, both on technicals and from economic data. But can't get ahead of ourselves, guys. Back-to-back beautiful years for the SPY and the QQQ, 20+% years back-to-back. We know this year we have to be a little bit more cautious in our positioning. So still, the trades I'm taking, guys, are not full YOLO, not fully committing to this bull market. I'm still being very selective on these plays, because we know at any point in time, the macro data can turn around, the market narrative can turn around, and that would not be very good for the markets, guys. So please keep that in mind. We're still battling with rates higher for longer, inflation narratives, Trump tariffs, deportation of labor, how that's going to impact prices, how that's going to impact the labor market as well, right? So all these things, we know that it's not a smooth sailing market right now. So you have to be very picky and very selective with the companies that we choose to play in this current landscape, which is why I'm favoring big tech overall. They have the most amount of free cash flow, the highest profits overall, and that is the more defensive sector that is mostly supposed to see the best form of expansion, if at all, this year in terms of free cash flow, margins, and otherwise too. So that's why you'll see me still put a lot of emphasis on big tech, and I'm not really looking to expand too much into financials, too much into healthcare, too much into other semiconductor plays other than NVIDIA and otherwise. And the consumer-facing ones, or the interest rate sensitive ones, guys, I'm really not playing that often at all. I'm sticking to what the market has shown me that the favored trade is and has been for the last 2-3 years, while we've been dealing with inflation, higher rates, and all the things we're dealing with right now, uncertainty factors. The favored trade of the last 2.5 years has been big tech to weather out that uncertainty storm. So I will still be playing that trade majoritively this year, of course, which is why I'm waiting for this earnings cycle to get any better levels on these big tech names. So that's everything for today's video, guys. Hopefully you enjoyed that. Friday videos will be a little bit longer as I have a lot to go through in terms of the whole overview and the trade recaps as well. But moving forward, Monday through Friday, unless it's earnings, of course, the videos will be getting a lot shorter, guys. I think you're seeing that I'm trying to make a, trying to make an effort to make them shorter. So hopefully that's being conveyed through doing stuff more in bullet point format and less of in-depth explanations. But if you guys want in-depth explanations of something I've explained in the video, just leave me a question down below in the comments. So thanks very much for watching, guys. That's it for me. If you like this video, consider dropping a like, would help me for the growth of the channel. Also consider subscribing if you're new, guys. We are so close to 5,000 subscribers. Let's get over there throughout the weekend. So thank you very much for subscribing. And lastly, guys, if you have any questions, always feel free to leave them down below in the comment section. I'll answer usually within the first 1 to 2 days. And in the event, guys, you want access to all these trades in real time, here are all the trades from the Discord. The green check marks are wins, little red signs are small losses. So here's all the trades from the inception of the Discord overall, very transparent with the wins and the losses. I show you guys them on the channel multiple times per week as well. So if that's something that interests you, the link is always down below in the description. In this Discord, we also do private live streams Monday through Friday for about 2 hours at the open, where I trade live and answer all your questions. You can also ask me all of your questions in our respective chat rooms, and I'll be very happy to answer your questions on stocks, options, real estate, crypto, long portfolios, and anything in between. And of course, tons of other tools I don't talk often about, such as private member videos, psychology, strategies, more advanced strategies that I do not put on YouTube. All those are available there. You also get access to all of my different watch lists, all my TA indicators, and also all of the annotations that I put on any single chart, right? All of these earnings annotations and whatnot, those come with the service too, and many, many more things as well. So if any of that interests you guys, the link to the Discord is always down below in the description. Hopefully to see you there soon if it interests you. And if not, I guess I'll see you back on the channel, guys. So take care. A pleasure as always. I'll see you tomorrow for the top 5 options of the week video. That's it for me. Have a good rest of your weekend. Peace.